Peter Churchhouse is Advisory Director of Morgan Stanley. He's in our Hong Kong studio. And Ben Pedley is here in Singapore in his office upstairs. He's Dow Jones Newswise senior currency reporter. And we're talking about the situation of potential interest rate rises. Ben, you've pointed to the fact that the euro-dollar futures have far exceeded Fed funds in suggesting interest rate rises down the track. Peter, let me just put the question to you. If the euro-dollar futures are correct and we're looking at such a strengthening of U.S. interest rates in the next 6 to 12 months. What impact is that going to have on this apparent economic recovery that John Snow seems to think is so well entrenched?
Well, as I said earlier, I'm not convinced that it is as entrenched as we've seen in the third quarter data. That's for sure. My sense here is that the markets certainly are suggesting that the interest rate cycle has run its course to the downside and that the next move is going to be to the upside. But again, this is not likely over the next 3 or 4 months or so, but on a 12-month view, that's very likely to be the case. I think most people are of the view that the U.S. economy will be stronger next year than the aggregate numbers for this year. I think we're expecting that also in Japan. So I think we are going to see that expectation that that certainly on the long end of the bond curve, I think you will see bond yields to the upside. But I think at the short end, I don't think the Fed's under any pressure to raise rates in the short term here.
Right.
But if we look at what that implication is for Asia, I think we're looking at a reasonably robust picture here as well.
No, I mean, there are all sorts of variables here, as Ben was pointing out here. Many questions yet to be answered, and the comments we've had from John Snow being not very precise. But let's assume all things being equal. We've got economic growth as it is right now. You're suggesting it'll taper off. A rise in interest rates of the real Fed funds rate within the next 6 months. I'm just thinking, Ben's talking about the dollar strengthening on the back of a strengthening economy. If we see a rise in interest rates, in this particular circumstance, it'll actually be negative for the dollar, won't it? Because you can't imagine the U.S. economic recovery is going to survive an interest rate hike at this early stage.
Well, at this stage, to be perfectly honest, an interest rate hike, if it comes in the middle of a very strong economic recovery, that's probably good news, because it suggests that the economy is recovering strongly enough to absorb that kind of thing, and that we are seeing an inflationary pressures picking up. But quite honestly, the data is not showing that just yet. So I think the short-term risks of a rise in the Fed funds rate is very low indeed. We've seen a jobless recovery. We're not seeing any inflationary pressures. We're not seeing any pickup on the job front. And I think the aggregate data for wages is down, not up.
Ben, what are currency traders saying to explain what the euro-dollars market is telling us, the futures market?
Well, I mean, clearly, you can't just lump in and say that everyone that trades 3-month euro-dollars in Chicago or elsewhere around the world is completely wrong. I mean, they're basing these assumptions about interest rate rises on the data that's been coming out of the US. And I know that there is an argument about the relative strength or otherwise in the data, but certainly overall, the data in the last couple of weeks has been relatively upbeat. If you look at the statistical correlation between moves in the euro-dollar futures market, there is a bit of a correlation in the sense that if there are expectations of US interest rates rising, or the 10-year US Treasury note is rising in terms of yield, that tends to be an environment whereby the dollar does reasonably well. Certainly the recent bouts of dollar strength that we've seen over the past 3 or 4 months against a backdrop of a generally weaker dollar trend, they have been consistent with periods of rising US bond yields. So I guess it comes down to, who's right and who's wrong on the US economy. At this stage, the euro-dollar futures markets are saying there will be recovery, it will be relatively strong. It does remain to be seen if that is the case, whether that will be sufficient to attract the foreign capital inflows in a sustained fashion to keep the dollar's head above water. But certainly this will help the dollar in its correction periods during this overall bear market for the US currency. But I mean, I can't see in any way, shape or form how the US administration can honestly claim, I know they can claim it publicly that they've still got a strong dollar policy, but Snow says he's misunderstood. they are more than happy that the dollar is weakening. And if you try to tell me that the G7 call for greater currency flexibility was just an esoteric one saying that freer markets are better than more rigid markets, that's just not the case. They want the dollar to go down, particularly against the Asian currencies, and it's no coincidence there's an election coming up at the end of next year.
I wouldn't dare try to tell you that at all, Ben. But just a quick final question. What is the reason for the fact that the euro-dollar futures are so much more convinced of a rise than the Fed funds futures?
Well, I mean, one point is that for the 3-month euro dollars, you're looking at 90-day T-bills. So it is a bit further out along the yield curve. So it's always going to be a bit more aggressive if you assume a normal yield curve about pricing about future interest rate moves to the upside. Notwithstanding, I would just say that the further out along the yield curve that you go, the more responsive, if you like, the moves are to prospective inflation. And I think it's probably reasonably likely that in coming months we will start to see inflation pressures pick up, and that's maybe why that longer term measure, albeit slightly, the 90-day T-bills, the yields are moving more to the upside than they are at the very, very short end, which is the Fed fund futures, which is the direct bet on what the Fed's going to do going forward. But I think also if you look at Fed funds, Taimur, I think they're pricing in still 50 basis points as a strong possibility by the middle of next year's. 50 or 75, it's still a significant tightening over the next 8 months.
All right. Look, gentlemen, we are going to have to wrap it up there, unfortunately. Thanks for your comments. Ben Pedley is with Dow Jones Newswise. Peter Churchhouse, Advisory Director at Morgan Stanley in our Hong Kong studio. Thank you both.